Hi, this is Randy Finney with Right Side of the Chart, and this is a pre-market update for Thursday, December 6, 2018. As promised last night, I came into the trading room. I took the day off with the markets being closed, needed to catch up on a lot of things, some errands, and then came in late last night, just checked the futures before heading to bed, and noticed that there was a big leg down, another big leg down in the futures. So I posted an update in the trading room, and I posted what I'm about to show you guys here, and there was a lot of buzz. Hey, is this a good time to short? Um, if you're not already short, or to add to shorts. My answer to that is, at least my opinion was no. Let's wait and see what the market's open. In fact, I posted the futures as a long trade setup, and I still think it is still a long trade setup, an objective long trade. And the way I categorize that or phrase that is, this is certainly an aggressive trade idea here. And I'm talking about going long the futures either last night or now. They're still right about where they were when I posted it. So here's what happened, and I'll show you my thought process here. We had a bear flag. This was the big move down right here, was the big move down on Tuesday, right? Then, even though the markets closed on Tuesday at 4 p.m., the futures continued to trade. They traded up to, I believe, to when the markets were scheduled to open Wednesday, and then they shut down, if I'm not mistaken. But then they resumed again last night. So this is a classic, and what I highlighted here, textbook bear flags in both QQQ. I should say, I'm sorry, ES, which we're looking at right here. If I don't make mentions, right up here on the top, the contracts. This is ES, the S&P 500 E-mini futures. NQ did the same thing. We'll get to NQ in a second. So you had the consolidation and then an impulsive leg down, and it's roughly met the measured target. The measured target on a bear flag continuation pattern, which is what this is you take the distance of the flagpole. That's the impulsive move leading down to the flag, not the entire move, not this. This wasn't impulsive selling. It was this. So there's your flagpole. There's your flag. Nice clean shape format to it. And then right down to support. And when trading bear flag pattern or any technical pattern for that matter, if I use I'll look at the measured target, but if a support level comes in before that, that's where I would opt to either cover a short or go long. So I mentioned this last night as an aggressive, certainly an aggressive trade, and I even said it has probably an increased rate of being stopped out, or it does, I believe, have an increased rate of being stopped out. There's some very um, obviously, some very bearish price action going on in the markets right now. May be related to some of the headline news in recent days, but you have to take it for what it is, and that's trading. You can either sit back if this is not your cup of tea, or like I said last night, and it's still right now as I'm doing this video, you go long as close as possible to 26.51. What I did here is there is a difference, another support level below. I should add if we get another jog down today at the open, and I need to add that line now. I didn't show this last night. 26.25. You see these reaction lows back here. Quite a few. There's some candlestick there, candlestick there. So you have if we take one more jog down, and that would be roughly in line, actually a little closer in line with the measured target. Again, there's a flagpole, and that would look about roughly equal. So this is really where we need to hold today, but we could stop here. This is a decent support level. This is the one I highlighted last night, and I also mentioned last night I referred to it as potential divergence because we hadn't yet confirmed the divergence right here, which we now have. So for those of you, members of the right side of the chart that were in the trading room last night or saw those charts I posted since then, you can see that divergence has now been confirmed. And what does that mean to me? Well, you don't always rally. Divergence isn't a buy signal, but when you fall down to support and you're near term oversold, which we are, so you have oversold at support with divergence, and you can see what happened the last few times the markets had a divergent low. Now, keep in mind, they had divergent lows here. We had a little pop, but it continued to go down and extend those divergences. So again, by no means is that a guaranteed buy signal or anything like that. It just says that, hey, if there was some overreaction to the selling in the last few days, if there isn't a hedge fund or a broker dealer or something blowing up, and I mentioned that on Tuesday, I don't know, the selling kind of seemed to be a little bit much for what was priced into the charts and for what the headlines were that day. Maybe there is something going on under the hood. For weeks and months now, I've talked about, which I still expect, the fact that many hedge funds, pension funds, their risk models are broken. They've broken. Everything has been going down. I've talked about that for weeks. There was another article in the Wall Street Journal came out, I think it was yesterday, the day before, about how cash is king, and that's what I've been telling members of the site for a while. My trade ideas have been unusually light, especially the official trade ideas, and they said what I've been saying now for months is that I'm doing that because there's just nowhere to hide. Everything has been going down, with few exceptions. We're long gold, we're long treasuries, we're long the few things that have been going up. But as far as stocks, this has been a difficult trade. You can see this. This is um, you can actively trade, and that's what we do in the trading room. Try to catch all these little micro rips and dips. But as far as swing trades, which typically have holding periods measured in months, at least a few weeks. Those are not, they're really not existent. They're very tough right now. It's more of a hit and run market, and you have to do very rapid active swing trading. Get out, get in, get out, trades that are lasting days, because these swings are so large that you're going to be stopped out. Even that rally off the recent lows, what was it, 8+%, I think, that would have stopped out most people who were short. So there it is. I just wanted to update the positive divergences, the fact that the futures are at support with another pretty decent support level below. But this is also critical support. If we get down to 26.25 or so and go much below, those are the previous lows. This was effectively a double bottom so far in the S&P 500 here. So let's watch those levels. But if we can rally from here, and again, my premise is I talk about trades being objective, and so if you can go long close to that 26.51 level with a stop somewhat below, it depends how much you're targeting, and allow for a runner trade. If you want just a bounce trade and you only want to bounce back to that flag or to this first resistance level here around 26.95 or so, then you want a tight stop. If you want to buy this, let's say you're bullish, you think the market's going to new highs, or at least going to challenge the old highs or something, then sure, you have a level here, 26.25. You give yourself a little bit longer, a little bit wider stop, and if it starts to work out for you, just raise your stops to break even at some point and allow for what I call a runner trade. A trade that can, eventually work its way on up here. So there's ES. Let's look at NQ, and we'll wrap this up so I can get the video out to you guys before the market opens. Last night, again, I had mentioned this as unconfirmed divergence. It is now confirmed, so let me get rid of the word unconfirmed and tell you that we now have on the 60-minute time frame divergent low, roughly equal lows on the PPO down here and slightly higher low on the RSI, while this is the levels, these are the levels I'm watching on NQ, the Nasdaq 100 futures, 66, 64-ish with another level below. I think I mentioned last night about 65, we'll call it 6,600, some give or take. And there's a lot of levels. There's been so much volatility recently. There are a lot of support and resistance levels both above, not many below, I should say. Once we take out these lows right here, then we go back and we're getting real close to those targets that I initially had, which were the lows back from earlier in the year, when we had those two legs down, those two back-to-back corrections. So there it is. Oh, and by the way, yeah, here's NQ. Nice symmetry to this flag pattern. There's your flagpole right there. There's what's happened so far. We've pretty much roughly hit the measured move. Maybe fell a little shy. So, I could see a little jog down at the open today, or just before the open. Come in here around 60, around that 65.98 level. That would be a move down about to the measured target there, and then a reversal. Now, if not, again, be careful because something's going on here. This is a lot of selling. This is impulsive selling. But, it's not like we haven't had that before, over the last few weeks. So sometimes these very impulsive rips are followed by nice kickback rallies. Just be careful. If this is not your cup of tea, wait and stand back, see what happens. But as far as shorting, let's look at the daily charts here. The markets haven't yet opened. This was Friday's close here. And right now, SPY is at 266.60 as I do this video. So that would put us down here, somewhere in here. And you can see, I mean, I can draw support lines all over this chart because again, we've had a lot of volatility, but I'm trying to draw the ones that are a little more significant. Um, I, I see decent, pretty important. I think the most important support level most likely is around 263 or so, because as I've mentioned before, although it wasn't technically a double bottom, a perfect double bottom, it roughly was. We had trading normalized right here, a couple candles on SPY, and then although we shot through there and had a little spike down intraday, we have three candlestick, either the the shadows of those candles or the bodies right there around that level. So give or take, we'll call it 260. And with volatility, you're going to move through those levels. Um, Beyond that, we have some support here, and that's where support starts to come in. So this was originally, and let's if we go lower, still remains my max downside range. And as I talked about in recent weeks, we'll come in here. There's the lows for the most part back from earlier in the year, and we'll either slightly undercut those lows and reverse is what I think, or come in and maybe reverse a little bit above them. No matter what, as you can see right now, we'll have some nice positive divergence. If we do take out the recent lows and we get down this level, we'll have some pretty strong bullish divergences on the daily chart of SPY. So QQQ, as I do this video, let's check another monitor, is trading at 162.94. We closed the other on Tuesday at 162.75. And again, I can draw lines everywhere, but here's one around 163-ish. We have a support level. And so we're a little bit above that. And same story there, although we already put in a divergent low on QQQ, and we did again have a nice pop from that. We certainly have the potential to extend those divergences as long as the indicators continue to make higher lows. So there's a scenario if we do get a flush out move, which is certainly a possibility now. Again, I'm looking at, and again, you have to frame this too. If you are looking to short, and I would say the same thing. If shorting, let's go back to the futures real quick for a second. If you want to short this market now, or you're already short, just don't get married to a trade. If they reverse it, and if nothing else, we've seen what can happen when these machines, the high frequency trading, these algo programs, they hit the buy or the sell signal or the buy or sell programs. This market can rip. So if you want to short, again, not my preference right now. I'm taking the other side of that at this point in time. But just make sure you manage your stops. Have stops in place. Futures are my preferred vehicle because they'll trade virtually around the clock. So if there's a big move overnight, I'm not going to get caught on the wrong side of a 3% plus gap in QQQ. But with that being said, you can only trade futures if you have a futures account, the amount of capital for it, and of course the experience, and you realize how those things work. So there's your levels, and again, so I'm viewing it's aggressive, step in, go long, and not really hang in there much below. I'm keeping my stops really tight. I'm not going to let it get down here, but this is just an active trade, a very aggressive trade, but which I suspect I would put better odds it'll be stopped out than pan out. But if it does pan out and we can get a nice rally here, another leg up, then again, I'm giving up a minimal downside for a lot of potential upside there. And if things go a lot lower, this is where I'm trying to go with this. I was on the QQQ chart a second ago. What did I say we're at right now? We're going to open again at 162.87. Let me put so a little bit above that level, or a little bit below this level here. So let's just look at downside potential. Let me move this line down here. Let's just say, well, let's just pick a target. Again, I think give or take within, I don't know, 3 percentage points somewhere. This will be the max downside before we have a nice rally, nice reversal. So we're already, again, this chart is reflective as of Tuesday's close. We're already down to under 163 right now, so we're somewhere down here. It's about risk reward. How much downside is there? So there's maybe another 5%, but we could snap back as well. And once we reverse, well, I don't think we're going to new highs at this point. Again, we've had a lot of evidence that shows us this is most likely a bear market rally, but here's a downtrend that we can start to watch. I really have to mark these charts up a little bit more with some Well, I did have these bounce targets from last week, so that they still hold, and that's where we stopped right there around that 172.11 level. But there's a downtrend line to watch now. So this is what it would look like if we do get a bounce here. Watch that level, watch that 172-ish level and this downtrend here. And if we get another leg down, like I said, uh, anywhere from this would be, I'll draw it out a little bit, somewhere in right about here. That would be my max downside target. When I say max downside target, again, if it is a bear market rally, or whether it is or isn't, the area where we'll go down to, I believe, before we mount a significant rally, something that lasts for more than just a few days or a couple weeks, maybe 4 to 6 weeks, or quite possibly more, and something that might be measured in the double digits, 10% or more. And again, we're going to open up somewhere around right here. So we're getting pretty close to that downside range where the risk reward starts to diminish. It is certainly better right now than it was here. Here I made it very clear that the risk reward was shifting, had shifted and started to shift from the short side to the long side, and covered most of our shorts. Mine personally went long on a lot of things. And then said the other day, I expected a fade of the gap, but we got more than that so far. So let's wrap it up here. I wanted to get these levels out. I don't want to ramble too much. We'll see what happens, and I'll do another update today, because one thing I can guarantee you is we're probably not going to sit here after such strong volatility after that big down day on Tuesday, and we're going to have another red candle at the open today. I doubt we're just going to sit there at those lows. We're probably either going to reverse and they're going to ramp it up today, or close it, big red candle down today, and maybe even take out where we're trading right now in the futures. But as of now, like I said, it's aggressive, but I'm leaning towards a pop up today, even if it's an intraday trade too, by the way. That, I don't know. I'd have to see a lot to convince me to take my long positions home if I'm not stopped out. So, but we'll see. If things look pretty decent, the charts start to firm up, maybe I'll just raise stops again and let that position ride for a potential runner trade. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Good luck on your trades today.